from 4.2% CPI to 2.23% real yields. Reading the bond market's true signal. Flint West reporting. The bond market doesn't care about your politics. It doesn't care about your feelings. It doesn't care about CNBC. And it certainly doesn't care about whatever inflation headline is currently making the rounds on social media. The bond market speaks a language of incentives. And right now, it's telling a very different story than most people realize. As of mid-June 2026, the numbers line up with unusual precision. DGS-10, the 10-year Treasury, sits at 4.49%. T10YIE, the 10-year break-even inflation rate, sits at 2.25%. DFII-10, the 10-year real yield, sits at 2.23%. Add the last two together and you get almost exactly the first. 2.25% plus 2.23% equals approximately 4.49%. The arithmetic is almost perfect. The market is simultaneously saying, we expect roughly 2.25% inflation over the next decade, and we demand 2.23% real compensation on top. That distinction matters, because while the newspapers are screaming about a 4.2% CPI print, the bond market is quietly saying, we don't believe 4.2% is the future. Section 2. The three variables that matter. Most people watch only one number, the nominal yield, the 10-year Treasury, the headline figure. But the market is actually decomposing reality into three separate components. DGS-10, the nominal yield, the number everyone sees. T10YIE, the market's estimate of average inflation over the next decade. DFII-10, the real yield, the compensation investors demand after inflation. Together, they form a simple equation. Nominal yield is approximately equal to expected inflation plus real yield. This is the practical version of the Fisher equation, and hidden inside it is the signal that matters. DFII-10, the real yield, the price investors demand for lending money through time. Section 3. Why DFII-10 matters. Here's what most people miss. Inflation expectations don't move that much. Historically, T10YIE spends most of its life between roughly 1.5% and 3.0%. Meanwhile, nominal yields can swing wildly from 0.5% to 15% or more, depending on the decade. That leaves DFII-10 trapped in the middle, compressed, squeezed, usually somewhere between roughly negative 1.1% and positive 2.5% in recent history, which is why DFII-10 charts often look boring, flat, unremarkable, until they aren't, because crossing certain thresholds matters enormously, especially zero. Section 4. 2 ways real yields die. There are only 2 clean ways for DFII-10 to collapse toward zero. Scenario 1. Nominal yields collapse. Suppose DGS-10 falls from 4.49% to 2.50%, and inflation expectations remain around 2.5%. DFII-10 approaches zero. This is the classic recession, banking stress, Federal Reserve easing, quantitative easing, and flight to safety environment. Treasuries rally, gold catches a bid, Bitcoin often catches a bid. Growth stocks can become absolute monsters. Scenario 2. Inflation expectations explode. Now suppose DGS-10 remains around 4.5% and T10YIE rises from 2.25% to 4.5%. Again, DFII-10 approaches zero. But this is a completely different world. This is fiscal dominance. Debt monetization fears, inflation scares, loss of confidence, bonds get destroyed, gold performs extremely well, commodities catch fire. Bitcoin often joins the party. Section 5. The most likely outcome. Reality usually chooses neither extreme. The more common path is a combination. Maybe. The 10-year Treasury yield falls toward 3.5%. At the same time, the market's expectation for inflation over the next 10 years rises toward 3.5%. Result, the real yield falls to zero. No drama, no crisis, just a gradual repricing of reality. Historically, that's how these transitions often happen. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 6. Why 4.2% CPI doesn't matter as much as you think. This is where most commentary goes wrong. People see CPI equals 4.2% and immediately assume inflation is back, The bond market disagrees. T10YIE remains anchored around 2.25%. Why? Because the market believes this inflation spike is largely energy-driven. Oil, gasoline, Middle East tensions, temporary supply disruptions. Core CPI is much lower. And more importantly, break-evens measure a decade, not a month, not a quarter, not a news cycle. The market is effectively saying, we believe inflation will cool. Whether that proves correct remains to be seen, but that's what the market is currently pricing. Section 7. The invisible number nobody talks about. Now we arrive at the truly important variable. R star, the neutral rate, the invisible benchmark, the short-term real rate consistent with stable inflation, full employment, sustainable growth. Current estimates place real R star roughly between 0.5% and 1.5%, which implies a nominal neutral rate around 2.5% to 3.5%. The Federal Reserve's own longer-run projection is approximately 3.1% nominal, or roughly 1.1% real. Meanwhile, the effective federal funds rate sits around 3.6%, meaning policy remains mildly restrictive, not dramatically restrictive, not crushingly restrictive, just enough to keep inflation expectations anchored. Section 8. Why the Fed never stops talking about expectations. The Federal Reserve can survive recessions, market crashes, banking stress. It has survived all of those before. What it fears is something else, loss of credibility. Because once the market's expectation for inflation over the next 10 years breaks upward, from 2.25% to 3% to 4% or higher, the entire Treasury market must reprice. Borrowing costs rise, term premia rise, debt servicing costs rise, and suddenly everyone discovers what financial repression actually feels like. This is why the Fed constantly repeats, inflation expectations remain anchored. That sentence is doing more work than most people realize. Section 9. The Bitcoin regime signal. Now we arrive at the practical takeaway, the investable thesis, the one chart worth watching. DFI 10. Because Bitcoin and gold tend to perform best when DFI 10 approaches zero or turns negative. Why? Because the opportunity cost disappears. If sovereign debt is no longer paying a meaningful real return, capital starts looking elsewhere. It moves into equities, real estate, commodities, gold, Bitcoin. Not because Bitcoin is magic, not because Bitcoin is a religion, because incentives change. The historical pattern. We've already seen this movie, 2020 to 2021. Real yields went negative. Bitcoin exploded. Risk assets exploded. 2022, real yields surged. Bitcoin entered a brutal bear market. Afterwards, real yields moderated. Bitcoin recovered. The pattern isn't perfect, but it is difficult to ignore. Section 10. Forward outlook. As of mid-2026, real yields remain positive. Policy remains mildly restrictive. Inflation expectations remain anchored. The Federal Reserve still has credibility. The key regime shift to watch is simple. Bullish. The real yield on 10-year government bonds falls towards zero. Neutral or bearish, the real yield remains elevated. That's the signal. Everything else is noise. Conclusion. The Treasury market is not merely pricing bonds. It is answering a deeper question. Is the government still paying investors a positive real return for the use of their capital and time? Today, the answer is yes, but less emphatically than many realize. And if that answer begins shifting toward no, then the entire investment landscape changes. Because Bitcoin is not merely competing with inflation. Bitcoin is competing with the real return offered by government bonds. And that is why the most important number in this entire discussion is not the inflation rate at 4.2%, the 10-year Treasury yield at 4.49%, or the market's expectation for inflation over the next 10 years at 2.25%. It is the real yield at 2.23%. Because that number measures the compensation investors receive for patience. And when patience stops paying, capital starts looking for the exit. Flint West signing off.